Welcome back, everybody. Pretty much everywhere you go online, the trendy thing to say now is that credit scores are a scam. Or maybe you get the opposite view, where credit scores are some measure of your overall wealth and success. Well, both of those things are simply wrong, and there's no other way to say it. And I know because I've lived through both sides of this, struggling with credit early on in my life during college, to as recently as last year having a perfect credit score of 850. Yes, that was my real score on the thumbnail. Now, my score isn't 850 anymore, and I'll show you why here later in the video, but clearly I have some experience with this. So in this video, we're going to break down why what you've heard about credit scores is totally wrong, how to actually get a good credit score since I've seemed to be able to turn that around, and most importantly, why any of this actually matters. So let's get started. Now, what got me started on this topic was a tweet that I saw, and it said this: "My credit score dropped when I paid off my debt. My credit score dropped when I closed a credit card from one of the worst banks. My credit score dropped when I applied for a better credit card. Credit agencies told me, quote, take more loans to increase your credit score, unquote. The system wants you in debt. Credit scoring is one of the biggest scams." Now, there's a lot that I could say about this, but in general, it's just very misleading. I mean, this is an account that's pretty large. It has over 400,000 followers. And look, I get it, right? This type of content is made to drive engagement, to increase their Twitter ad revenue, and I'm not mad at it. This is just how it goes, and I understand that. But it can drive people to getting the wrong idea about credit scores, and I think we'll see here a little bit later that that can be a really big negative depending on your situation. But now, back to the original point. The truth is this: credit scores aren't a scam. Now, we may disagree on if they're useful or if they're fair or if they're the right measure, but they're not a scam, and here's why. A credit score is simply a tool that lenders and companies use to get some kind of idea how likely you are to keep up with your financial responsibilities. So, of course, anytime you apply for a loan, they're going to look at it. If you're renting an apartment, they may look at it then too. Or even if you're applying for a job that has special access or clearance, they'll probably be looking at it then too. And the reason why they look at it is because they're trying to evaluate the amount of risk that they're taking on by lending you that money or letting you live in that apartment or giving you access to that database. And look, here's why. They don't know you personally. They don't know that you helped that old lady across the street that one time and you're a total stand-up guy. They're simply trying to evaluate how much risk you present to them based on your history of dealing with other people's money. So any loans that you had, any credit cards that you had, or any missed payments or bills that went to collections. They're simply trying to protect themselves because they don't know you. I mean, come on, let's stop being offended about everything. Not everything is a conspiracy. Because you'll hear people who don't use debt often say, "It's not fair, my credit score is so low," or "I don't have a credit score because I don't use debt." Well, yeah, you don't use debt. How could you possibly have a good credit score? They have nothing to go on. Like, this whole rage mentality online right now, to me, is super annoying. And I would say, young people out there, don't take the bait. At the end of the day, a credit score is just a tool. It's a financial tool, and in my experience, the people who are the best with money are the ones who don't sit around arguing about right or wrong all day. They're ones who take the time to understand how these financial tools work and then understand what they need to do to be able to take advantage of them as much as possible. And when I say take advantage, I don't mean in some evil, malicious way. I mean just do the things so that you can help yourself later on. And that's what we're going to talk about next. So why are credit scores actually important? This is another area where a lot of the content online is really misleading. People say, "Hey, look, my credit score is really good. This shows how successful I am," or "This shows how wealthy I am." And it literally does not show any of that. It literally shows, here's my score, my relative score of how well I've paid my bills over a period of time. And based on the bills that people have access to, specifically the credit rating agencies. Is it going to tell you that you're super wealthy? No. Is it going to tell you that you're super successful? No. Does it mean that if you have a poor score that you're not very wealthy? No, of course not. It means nothing. It is literally a tool to say, here's how well I've paid back other people's money over my lifetime. That's it. That's all it tells you. But just because that's all it tells you doesn't mean that it's not important, because the reality is that most of us have to live our lives using debt at some point. And that's whether we want to buy a house, we want to buy a car, we want to go to school. These are all things that people commonly get loans for. And the reality is that your credit score and your credit history is going to really determine how much you pay in terms of interest, or if you can even get approved. And I've seen on some YouTube videos where people basically say, "Oh, it's no big deal because all you do with these loans is buy a bunch of dumb stuff." Or, don't buy a car with financing, go buy a car with cash, and only buy a car you can afford with cash. And honestly, when I see these type of videos, I really question if these people have lived in reality or if they have some special situation that is not normal for most people. And I understand the sentiment of if you can use cash, do that so you don't get into debt, don't pay interest to someone else. But I think for the majority of people, it's just not a realistic thing that you can do, especially with how much cars cost these days. Like, people have lives, they have kids, they need to take them to school, they need to drive to work. These aren't necessarily things that you can just do with an all cash car, depending on how much cash you even have. Like I told you guys a story about when we were really young and I actually cashed out the little I had in my 401k at the time. It was only like a few $1,000s. And we bought a car for my fiance at the time because she needed a car. Like the car broke down. We had no other options. At that point in time, our credit wasn't very good. And so, yeah, I took it out of investments. And people say, oh my goodness, that's such a terrible financial decision. We literally had no other choice. Like that is what had to happen in order for us to keep living our lives, keep going to work, which was critical because we're living paycheck to paycheck. So I think some of these pieces of advice that I see online, they probably have good intentions, but in my experience, they're not always based in reality. And this brings us back to the critical point about why a credit score is important. A credit score gives you options when you most need it. And what I mean by that is having a good credit score means that you're more likely to get approved for financing whenever you need it. And it also means that when you do get approved, you're getting approved at the best possible rates that help you over the long term by reducing the amount of interest that you have to pay on any loans that you take out. And I have two specific examples in my own life where we've used this to our advantage. Now, my wife and I, when we first started, we didn't really have great credit scores and our credit was really struggling. It's something that we worked on over time, and we'll get into how you improve it over time here in a minute. But the first example from my own life is one of our cars just broke down. It was a car that I was driving and it had an issue that just couldn't really be fixed, and we needed a car. So we literally went to the dealership and were able to buy a car like that day with no money down, no money that I had to bring from my bank and do all this type of stuff because our credit was so good that we got approved and we got it at a decent interest rate, right? So that was a situation where, we built over time to make sure that our credit was improved and we had a decent score. And then in the moment that we needed it, we were able to simply walk into a car dealership and get a car, right? That is very powerful because you don't know when life is going to happen, right? And life doesn't, happen in these magical steps where you're like, oh, I've totally planned everything out and I'm only going to pay with cash. And now, hey, look, I have all my cash and I'm going to buy my car. That's not how it works, right? Life is like, hey, great, you're doing good. You have a lot of plans. Psych, here you go, you have a new problem. And those are things that having good credit can just help you deal with in the moment. That was one example. And the other example was just this year. So we had an AC that had to be replaced. It was like a 20-year-old AC. And so we did that. But I don't know if you guys have actually checked prices for what it takes to replace an AC unit in 2024. It's very pricey, but we had to do that. And it's not something where I had the cash on hand. Like, of course, yes, we have investments and those type of things, but I don't want to liquidate them, right? And I don't want to have to do that. And because we had good credit, they had a special going on where you can get a 0% financing rate over a period of time where you pay no interest, right? And so we did that. And we did it immediately that day just to say, look, 0% interest over the lifetime of this, loan or revolving credit. And that's how we got our AC fixed without having to liquidate investments or even having to pull from our emergency savings, right? So again, it's just a tool. A 0% finance loan is a tool. A car loan is a tool. None of these things are inherently good or bad, right? We still have to have the personal accountability and responsibility to pay our bills and not take on more than we can actually afford. That's on us. So, when I see people say that credit scores aren't important, it doesn't matter. They do matter because what happens when you don't have a good credit score is that you get a loan because you have to. You're in dire straits. You need a car to get to work. You have no other choice. And so you find a place that will approve you no matter what. Chances are they're doing it for a very high interest rate that really screws you in terms of how much you pay. You see all these stories that say, oh, I'm paying on my loan and the principal's not going down. A lot of times that's because people have really high interest interest rates. And it's one of those things that snowballs in reverse. Like people talk about snowballs in terms of investments that keep compounding. Whenever you're constantly getting high interest rate loans, it compounds in reverse. And that's not something that you want to do. And the problem is that if we're constantly telling people that it's a scam and it's stupid and you shouldn't worry about it, then it means that they're not going to prepare the way that they could to really be able to have it help them in the future. Okay, so you're probably bored hearing about how I used credit in the past and you just want to know, look, I hear you, how do I actually get a good credit score? And let's break that down. Now, first off, part of why it's confusing is there's more than one credit score technically. There's 3 credit agencies in the US that people primarily use: Experian, Equifax, and TransUnion. And you can have a specific score at each one of the agencies. And this is why people always say to make sure that you keep up with what's on your credit report, because it can be different at all 3. And you can log into each one and actually get it with your own personal information for free. So it's not something you have to pay for, to at least be able to check up and make sure the information they have on file is correct, because sometimes it can take a while to fix it. And you don't want to be doing that when you're trying to get a loan. Plus, creating free accounts at the credit agency websites is a great way to be able to do things like add a freeze to your account if you're worried about identity theft, and just to be able to protect your credit overall. So I'll put links in the description of this video to each one of the 3 credit agencies for the US. Now, the score that people know about the most is the FICO score, but there are different FICO scores like FICO score 8 and FICO score 9, as well as something called a Vantage score. And so you can see why it's confusing. There's slightly different scores that use slightly different data points, and the lender that you're using at the time may use a specific one for a specific reason. But what I found is that they're relatively in the same ballpark in terms of score, as long as your information is up to date and you don't have any errors. But let's talk about what actually makes up your score. Now, it's based primarily on 5 factors. The first one is your payment history. Now, this is the most significant factor. It reflects on how consistently you've paid your bills on time. So, late payments, defaults, or accounts and collections negatively impact this portion of your score, and that accounts for 35% of your credit score. Next is the amount owed, and this factor measures your credit utilization, which is the ratio of your current credit card balances to your total credit limit. Keeping your utilization below 30% of your available credit is ideal for maintaining a good score, and credit utilization comprises 30% of your credit score. Next up is length of credit history, and this is basically the longer your credit history, the better. This factor looks at the age of your oldest account, the average age of all accounts, and how long it's been since you used each account. And now next, making up 10% of your score is your credit mix. Having a variety of credit accounts such as credit cards, retail accounts, and installment loans can boost your score, as it shows that you're able to manage different types of credit. And then the last 10% is based on new credit. So opening too many new accounts in a short period can lower your score. Lenders may view it as risky behavior if you seek multiple lines of credit at once. So let's just think about this logically. We look at these factors and we say, okay, why are these important? So number one, payment history, right? This is literally, have you paid your bills back on time? And what is the ratio of how many you've paid back versus how many you haven't? Or how many late payments have you had over how many years? I mean, this is very simple risk mitigation, right? Probabilities that they're doing. Then if you look at the next one, credit utilization, they're saying, okay, this is your credit limit of X. How much of your credit limit are you using now? If you're using close to the max of your credit limit, well, that's risky behavior, right? That's risky behavior that they have to take into account if they're going to lend you new money, because you're already getting close to the brink of your limit. Now, if you're one of those people that has a really high limit and you're only using a very low amount of your credit, then again, that seems less risky because you're managing the credit available to you already in a responsible way. And then if we look at length of credit, I mean, quite simply, how long have you been reliable for, right? If you've been reliable for 20 years, that's worth more than if you've only shown you've been reliable for 6 months. I mean, this isn't rocket science. And then credit mix, it's okay, if you have a credit card and a mortgage and a car loan and you're keeping up to date with all of them, then again, it just shows that you've been responsible across multiple different types. Now, does that mean that it's worse that, you only have a credit card and you've never had a mortgage? I mean, not necessarily. I mean, again, it's only 10% of your score, so it's not going to make a huge impact. And then lastly, new credit. If we just look at it logically, if you opened a bunch of new accounts and we don't have the history on those yet, then yeah, it's a little bit more risky than an account you've had for 20 years and you've paid every month on time. So you can see that, these things don't have to sound scary or like they're a conspiracy. They're pretty logical when you just look at them and say, okay, I get it. If I was a person and I was lending you money and I didn't know you personally, then I would want to have some information to tell me how reliable are you. And these factors all make sense in terms of why they're part of the score. And so at the end of the day, how to get a good credit score is very simple. Step one is simply pay your bills on time every month and do it over a period of years. That's going to build up your payment history. That's going to show people that you're responsible with your money and you don't miss a payment. Two, any credit that you actually do have, make sure that you're not maxing it out to close to the limit every single month, because if you do that, it's viewed as risky to lenders who want to loan you money. And there are people that say, make a payment before your statement date is up so that whatever they report to the bureaus will be a lower amount. And you could definitely do that. I mean, again, you have to decide how important that is in terms of how much utilization you're using compared to how much you're not. But those are things you can do knowing that whatever they report is going to impact your utilization score. In terms of length of credit history, I mean, obviously this is just how reliable you've been over time, so continuing to be consistent over time is going to help this without you really doing anything extra. And then in terms of credit mix and new credit, my opinion is you don't really need to concentrate on those all that much. Like, you shouldn't go get a new loan just to improve your credit mix. Like, you should only get a loan when you need a loan. I mean, this is very basic stuff. It's only 10% of your score. It's not a big deal. If your score isn't very good, getting a bunch of new loans isn't going to help it. It's probably an issue either with payment history or with utilization, and you should focus on those first. Now, ultimately, your credit score is going to fluctuate up and down just on a month-to-month basis, maybe because your statement balance was higher this month, and so your utilization went up. And those are things that in general, you shouldn't have to worry about on a month-to-month basis unless you're in a situation where hey, I'm trying to get a mortgage soon, I'm trying to buy a car soon. And in those cases, you may want to manage it a little bit closer. But I told you at the beginning that at one point last year, I did have a perfect 850 credit score. I just happened to open it that day and I was like, what? That's weird. I'd never seen that before, actually. So I took a screenshot of it. That's why I have a screenshot. But as you can see, it fluctuates and it started to go down. And this is actually a really great example because when it went down was when we got that new loan to replace our AC unit. So taking on that new credit, increasing my overall utilization because I got a new credit account basically is what brought my score down. I mean, it's not really hard to understand why things happen. You can say, oh, that's not fair. It's not whatever. I mean, it's just a calculation. But for me personally, it's not something that I worry about because I know why it happened. And my credit score being good was part of the reason we got to take advantage of that offer in the first place. So as you guys can see, a credit score is not a scam. It's also not anything that tells you how successful you are or wealthy you are. It's simply a tool for lenders and other companies to use to evaluate how good you are at paying back bills, because that's what they care about. They want to make sure that you're not too high of a risk to where they lose money. Simple as that. But that being said, a credit score can be a really great tool that helps you whenever you need it most. And so I highly recommend you get in the habit of paying your bills on time, watching your overall utilization, and just being overall responsible when it comes to paying your bills, because that's a habit that we need to be doing anyway. Like, there's no reason to be watching investing channels and doing all these things if we can't get the basic steps of just paying our bills on time locked down. Now, if you enjoyed this video and you want to know the truth about Social Security and investing, click on this video right here. Hope you guys have a great day out there. Financial independence is true freedom. So keep building and stacking wins, and I'll see you on the next one. Peace.